So today's agenda, the first thing we always like to do is like, where did we come from? Where are we right now? And then we do our scorecard of what we said was going to happen. We talk about what we're going to do next year. We're going to give our themes, then we're going to do our panel with our partners, and then we're going to give our 2025 predictions. So how did we do, or how did the markets do last year? I know this is a little bit of a busy slide, but we'll try to be succinct with it. So in 2024, the S&P, which is kind of the yardstick that you use for the equity markets, not great, always a great yardstick, but you know, we had to measure with something, was up a little over 25% last year. It was actually up more than that, but it sold off right at the end of the year, and I'm going to talk a little bit about that in a second. The equally weighted, remember the S&P's market weighted, so NVIDIA and Apple, they have a much bigger effect than maybe Disney and Boeing may have because they're a bigger box or bigger portion of the S&P. The NASDAQ was up 24.88. Dow Jones was up a little bit less than 13. Mid cap was up about 14. Small cap was up about 8.5. Growth, again, outperformed value, was up 32 versus 16. The international markets did not fare so well. Now, what's interesting about that is the international markets, the EFA, which is large cap Europe and Asia, it was up double digits until the election happened. And then because what happened with the election, all the international markets sold off because of the threat of tariffs and other types of policies that the new administration is going to have. The emerging markets were up even more than that. They were up in the teens, and they sold off substantially, and I'll show you a chart which shows that here in a second. So the aggregate bond market did, again, eke out a little bit of a gain, but not much. The 10-year Treasury started at a little below 4, and so did the 30-year, and they finished at 457 and 479. What's interesting now is we actually, the yield curve, which is where you borrow time versus amount, is essentially flat now, because the short-term rates are about 4.5, long-term rates are about 4.5, so the yield curve is very flat. It's been inverted for about the last 15 years. Oil prices finished flat for the year. They went up and down during the year, but they essentially finished where they started. Gold had a great year, and again, that was a catch-up from inflation that we've had. And then the dollar finished up. Again, the dollar was down against other currencies for the entire year until the election. And then right after the election, the dollar spiked and went up almost 10% against the euro and against other Asian currencies. And it did because of U.S. economic policies and the tariffs. So it's a good time to go to Europe or travel if you're going to travel, because you can get more for less. So, and then the home prices were up about a little over 4% last year. So this shows a little bit about the big indices last year. You know, we had several big corrections. We typically have, remember this, there's typically a correction right at March. There's also typically a correction usually in August, September, and it usually starts in July. The market usually hits a high in around the late part of July after earnings come in. So we had the same thing. This was about a 10% move. In September, we had this little tantrum, I would call it, right here, where the unemployment number came out, and it was worse than expected, and so that we thought that, you know, the Fed was not going to be able to reduce rates more, or needed to reduce rates more, and the market sold off about 7% here. And then right at the end of the year after the election, we had this big spike, and then the market sold off towards the end of the year. And then it sold off in January. I'll go ahead and tell you why. But you know, early in January, the market really was bumpy. The reason why the market was bumpy in January was because of rebalancing the portfolios. So the standard institutional portfolio that most people use at trust banks, or you know, is measured, is not 100% stock. It's usually 60% stock and about 40% fixed income. Well, when we showed you the slide earlier, we said the market was up 25, and the fixed income market, it generally was up about 1.3. A 60-40 portfolio would have gone to about 78-22. So you had to take a big portion of the stock portfolio and rebalance it onto the bond side to get back to 60-40. Well, clients, one of the things that clients hate worse than losing money is, guess what? Paying taxes. Almost as much as losing money. And so clients, told everybody, don't drop a big 1099 on me that I'm going to have a big tax bill in April by rebalancing my portfolio in December. So it all got pushed because the markets went up so much and the fixed income markets didn't go up at all the rebalancing got pushed until early January, and that's why the first few weeks of January were negative. And now the market's starting to rebound. It's because all that money from profit sharing, bonuses and stuff is starting to flow into the market. So, we had these, all the markets had these big times, and you can see that this magenta line right here is the emerging markets. So you can see it had a great year. It was tracking pretty much just a little bit behind the S&P, and then after the election happened, it sold off. Same thing with the international market, which is the green line here. You can see it. It was up not as much as the S&P, but it sold off after the election as well. So, all right. I know this is where everybody loves to see Todd get beat up. So we had 14 predictions going into 2024 a year ago today, and it's really hard to get these straight because a lot of times it doesn't go by calendar year. It happens maybe from March to March or April to April for different reasons. So it's hard to get these right, and I know I'm trying to suck up to everybody and tell you how hard it is, and you don't care, but here are the answers. So that we said, first of all, we said the U.S. markets would have a good year and hit all-time new highs. We got that one right. And that's the most important one of all the predictions we have here. The second one, we said that the markets would broaden out past the Magnificent Seven. Now, I've said earlier in the presentation that a lot of things were on track up until either the September or up until the election time. And after the election, Donald Trump screwed everything up for me, and we lost a lot of these things because right after the election, Tesla went through the roof, and Apple hit an all-time new high, and Meta hit an all-time new high, and at the end of the year, about 4 or 5% of the market return was pushed by the Magnificent Seven. So the market had broadened out through the election, and then what happened was all the stocks went through the roof, especially NVIDIA, right after the election. So it was actually the Magnificent Seven in 2023 contributed about 28% of the return of the S&P 500, so about a third. This year, the Magnificent Seven contributed to 56% of the return of the S&P 500. So I can show you a chart that I have on my laptop up here if you want to see it, but essentially the 7 stocks contributed 13.5% of the 25% return, and the rest of the stocks contributed about 11.6% of the rest of the return. The rest of the 493 stocks. So the market was very, very narrow. When the market, I've been doing this will be my 34th year, whenever the market's narrow like that, it creates significant risk for indexing and not being diversified. So we missed that one because of what happened during the election. We said the developed international markets would have a good year. Well, again, the election screwed it up. I showed you the chart. They all sold off after the election because of the tariffs and all the other policies that we're going to have pro-American. So we missed that one. So we're not starting off on a very good foot, but it gets better for us. So we said energy prices would remain between $60 and $90 per barrel because the U.S. was producing a lot of energy, and every time the oil prices came down to the 70s or high 60s, it would bounce off of that because we have to restock the Strategic Petroleum Reserve because we drew it down by 180 million barrels, and that's exactly what happened. Oil got up to the mid-80 level one time, but it never really got below 65. So we got that one right. We said short-term interest rates would fall slightly, and then in the text actually said that we thought that we would not see any, at the time when we did this in January, the predictions were the Fed would reduce rates in March the first time, and they would reduce rates again in the summertime, and there would be more than 4 rate cuts, and it could be up to many as 6. And I said I didn't think that was going to happen. I thought that the rates would be reduced in the back half and probably the last quarter of 2024, and that's exactly what happened. The Fed cut rates 50, 25, and 25 in September, November, and December. So we got that one right. We said long-term interest rates would be range-bound between the 3.5% and the 5% level. That's exactly what happened. So we got that one right. We said the dollar may weaken. Now I got kind of hosed on this one too, because again, I showed you the dollar right after the election. The dollar rallied. The dollar was weak the whole year, but the dollar strengthened towards the end of the year, so we missed that one. We said unemployment would rise but not be significant. Again, We talked about that when I was showing the charts. Unemployment spiked to about 4.2 in September, which is when we had that little sell-off in September. But it still was, 4.2 is considered full employment, so unemployment remained low, so we got that one right. We said corporate earnings would rise. Corporate earnings rose about 16% last year across the board, so we got that one right. We said that we have no recession. We didn't have a recession, so we got that one right. Said the housing market would not collapse and remain strong. That happened. We said there would be political gridlock. I think everybody would agree we had nothing done last year pretty much. We said inflation would continue to decline. It did, which is why the Fed cut rates. And we said we had volatility, which I showed you the volatility on the charts where the market moved multiple times in significant levels, of some of them double digits. So we got that one right. So if we look at that, we got out of 14, we got 11 right. And actually, I gave myself, I had to fight with my partners over this, but the emerging markets were up about 8%. So they still had a good year. Not great, but they had a good year. So we said we got 11.5 out of 14, which was an 82%. So